Hello and welcome to our financial market review. As expected, last week's breaking above the 1.5% threshold for the 10-year US yield triggered a massive sell-off in US equities, particularly in technology stocks. Even if 1.5% at 10-year may seem low, it is more than the current average dividend yield on the S&P 500. It was not Powell's speech to Congress that reassured investors, since inflation remains a non-issue according to him. It is very likely that the United States will experience a rise in inflation in the second quarter due to the base effects of last year's weak commodity prices. But the acceleration of that utilization will have a deflationary effect in the medium term. All this would enable the Fed to maintain its current monetary policy until the economy gets back to full employment. Employment will be this week's theme in the United States. Wednesday and Friday will witness the publications of private job creation figures and the unemployment rate for February. A figure that is significantly positive could potentially indicate that the Fed might tighten credit conditions more quickly than expected and thus impact market liquidity. For the moment, the American senators will wrangle the Biden plan after the approval by the House of Representatives last Friday. The final green light, which is expected by mid-March, will support the equity markets at the beginning of this week. On the European front, the rising interest rate is also a cause of concern. But the reasons are mostly geared towards the rising cost of refinancing companies and governments. The inflation figures published this week could prompt an intervention from the President of the European Central Bank. Finally, during the week, the final economic activity figures should confirm the contraction of the Eurozone in February and the good health of the US economy. Chat again next week for our next roundup. Have a nice week ahead.